Everybody, Mike DeSepoli, Heritage Financial Advisory Group. Welcome to the Heritage Market Update for Thursday, August 18th, 2022. Beautiful day outside. Hope you're having a great week. We have a lot of information to bring you up to speed on here today. I got a few distinctly different charts and cases I want to make to you on this video. We want to give you both sides of the argument here from the market participants, as we see it, and let you know what everybody on Wall Street is watching right now. So, had a nice rally, right? Coming off of the late June lows, strong month of July, good start to the beginning of August. And what you're looking at on the screen here is the S&P 500. Now, what we are trying to convey here is two separate things. Is number one, we know that the market made a high in January and has been in a downtrend since, with a couple failed rallies along the way. Well, where did those rallies fail? They failed at this downward sloping resistance line, right? So it's very clear that the market has been in a downtrend in this downward channel since the earlier part of this year. Each time that the market had tested this downtrend, it tried to get above, failed, and unfortunately went lower, right? So here we are again with the market making a strong move off the low and testing the overhead resistance that is this downward trend line, right? To take it a step further, this time being different than the other previous retests of the downward trend line, we have our 200-day moving average, right, which we've talked about previously, but just as a quick primer, the moving average tends to take the market price action and smooth it out. That's why this line is a lot smoother than the volatility that you see in the market indexes, but it tends to act as a support and resistance level as well. So we have a scenario here where not only is the market converging on a downward sloping trend line, it is also converging on an overhead 200-day moving average. So it is natural that the market moved right up into this area and has basically been marinating now for a couple days, right? Markets haven't really done much for the last 2 to 3 trading days since we really bolted right into this area. Now, just because the market is meandering around at these levels does not mean that that's a signal that we're going to roll over and die again. We could move higher, we could break through, turn the overhead resistance into support and continue on, or the market could weaken at these levels. Now, again, it takes usually at least 5 trading days, if not more, for a market to reach and decide what it's going to do at a critical level. But nonetheless, that's where we are today. So naturally, we are seeing volumes are drying up a little bit as investors watch, wait, and see what the market does at this level. So now that you kind of have the idea of the market backdrop, I'm going to give you 2 potential scenarios as we see it, right? There's a case for the bulls, and there is a case for the bears. So I am sure if you're on social media, if you're following the financial news, CNBC, Bloomberg, etc., I'm sure if you're paying attention, you have seen this chart. Okay, this chart is making the rounds right now, and all the perma bears are using this as their base case for why the markets are due to go lower. So what you have here on the left is the S&P 500 from that brutal period in 2008, and what you have on the right is the S&P 500 from the start of this year with an analog drawn on it, right? The continuation, if you will, if we were to mirror 2008. So where we are now on this chart is essentially 0.6, right? Okay, we drew this up probably about 2 weeks ago, and since that point, markets have moved a little bit higher, and basically we are close to 4,300 on the S&P 500. Now, again, the price levels are different than '08, right? Because markets are markedly higher, right? And back in '08, this price level here was 1448. Now it's 4,300. So just as an aside, it shows you how well markets do over time to move higher. But nonetheless, market technicians are looking at these 2 charts and they're seeing a lot of similarities, right? Just in the 5-wave sequence down, right? Same thing here. And then the advance, right? Wave 6, where in '08, people felt this was the all clear. Obviously now we've had this move very similar and people are feeling better, right? Stock market bulls are rejoicing. So a lot of the bears, the naysayers, are making the case that the market's going to come into this level, right, which so happens to be a confluence between our downward trend channel and the 200-day moving average, and they expect the market to roll over and die and go make new lows. Now, this is just an analog, right? So people always say, the past doesn't always repeat itself, but it tends to rhyme. However, it needs to be said that in 2008, we were going through a systemic financial crisis where there was fears that we were going to lose the banking sector, right? So this time is not that, but nonetheless, in investment management, we have to have our head on a swivel and be aware of both the bull case and the bear case, okay? So this is the bear case. This is what the naysayers would say is going to happen next. Now for the bull case, okay? Let me make this a little bigger because we have a scenario on our hands here. Hold on one second. Okay, hopefully that's a little bit better to see. So now we have a scenario here where the markets have just thrown off a signal, an indicator that's been successful 100% of the time over the last 70 years. Now, since 1950, any time that we have had a stock market decline of 20% or greater, and the market went on to retrace at least half of that decline, right? They call it a 50% retracement, right? So let's put it in numbers terms. You have a 30% stock market decline. The market retraces 15% of that decline. That is a 50% retracement. Anytime that has happened since 1950, 100% of the time that that's happened since 1950, the bottom was in the market, and the market never went on to make new lows. So that's what the data is that you're looking at here in the chart. Did the market make new lows after we recovered 50%? The answer was no, 100% of the time. And we have that in a chart form here, thanks to our friends at Carson. And you can see, based on the green dots on the chart, these were the previous instances where markets were down big, retraced 50% of that decline, and went on to move higher. So again, a case to make for the bears, they'll say that this is 2008 all over again. A case to make for the bulls, anytime stock markets retrace 50% of their decline, the bottoms are in every time since the 1950s. So that's the case we're making on both sides. We just need to be aware of both cases. That's why right now, as we move into these overhead resistance levels, you'll see that we're making some minor changes in down weighting a few positions, just taking a little money off the table. There's probably about 3 to 4 positions, stocks in our portfolio that have more than doubled since the lows in June. And as much as we like that and we think it can continue, it is always smart to take some money off the table anytime markets give you an outsized move like that in a very, very short period of time. It's not normal, folks, that stocks go up 100% in a 30-day period, right? So we need to acknowledge that for what it is and be smart about it. Taking a look at today in the market, just a pretty choppy day. Markets were relatively flat. I think we finished, marginally higher across the board. But we saw some actual good leadership today in the semiconductors, right? In the area that's just the heartbeat of this economy. Very strong today. Gains of 2 or 3% in a relatively flat market is pretty good. And it looks like energy and the oil and gas sectors are starting to wake up yet again. Not a great sign for inflation, right? We thought oil was peaking. Still may be, but today these stocks would be suggesting differently. But overall, we've seen some pretty good activity over the last month. Very strong moves. And now the market is marinating at a very critical level. Let's take a look at our fear and greed index, see how the average investor is feeling. And we're right about where you would expect to be. Very neutral, right? Awful start to the year. Nice rally off the lows. Investors still very confused. Not sure which way do we go next. A neutral reading to us is something that makes a lot of sense. So again, just going back to our first slide, markets at a very important inflection point. I expect us to move sideways here for a couple days, maybe a little bit of a retest above it, kind of probing around before we ultimately get that decision on which way the market's going to go. Yesterday, we did get the Federal Reserve minutes from their meeting last month, so kind of looking at things after the fact. But the minutes suggested what we thought is the Fed knows that they have pushed this economy, very far, very quickly in terms of tightening interest rates, and they acknowledge that they don't want to go too far, too fast, and cause a severe recession. So I think the market did like that, but nonetheless, it's wait and see time for the market. So again, as far as any new positions, we would be holding off right now on adding to anything until the market talks, right? Because the market will speak. It is up to us to listen. So if you have any questions, reach out to us. We're always here to talk to you about the things that matter with your money. Our eyes are glued to this scenario right now. So if you're here, you have anything you want to run by us, we're here for you. We're always going to be here, and we're going to make sure that we see through to the other side of this successfully. Have a great day, and we'll see you back for the next Heritage Market Update.